Welcome back to the Daily Drum on WHUR and Sirius XM Channel 141. This is the Inside segment. I'm Harold Fisher. We all know this is the season of giving, but it's also time for us to prepare for the season of taking, as in Uncle Sam, taking your hard-earned money during the upcoming tax season. Well, believe it or not, there is still time to make money moves before the end of the year that will soften the blows for those who may owe in April of next year. My guest is Stephanie Fauntleroy, owner and director of Baker's Tax and Accounting Services. Stephanie, thank you so much for coming on and helping out. Hopefully we'll help some people as they begin to think about the season of taking during the season of giving.
Well, listen, I'm here to help. Thank you so much, Harold, for having me. I always love joining you and talking to your folks.
Well, let's talk about 2025 first. What changes have happened this year that have kind of flown under the radar for people who, who have to, like all of us, pay their taxes?
I will say, first of all, it's going to be a year. It's going to be an interesting year for folks coming up in 2025, when 2026, rather, when we're doing our 2025 return because of the one big, beautiful bill, right?
Mm-hmm.
So President Trump, he signed that executive order in July of this year. So there will be some significant changes to our tax code going forward that I don't know if people are really aware of how those changes will impact them, like you suggested, right? So I think one of the major things that I've talked about before, because it was a detriment in my mind to taxpayers, specifically in my geographical area, because our incomes are a bit higher in the DC area. They're a bit higher. Metropolitan areas like New York and California and DC, we have higher incomes. So when the 2018 tax laws came in, they capped our SALT deduction, which is the state and local tax deduction. It capped it at $10,000. That's a problem for people that live in our area that have higher incomes, when you can normally deduct your state taxes that are withheld from your paycheck, you can deduct that in addition to your property taxes, right? So if you're deducting your property tax and the state tax withheld, you might be deducting $25,000 from your income. 2018 said, nope, we're going to cap that at $10,000. People owed money and they were just blown away. Like, wait a minute now, I never owe money. You mean to tell me I'm paying these high property taxes in PG County and they're taking out all of this income tax out of my state income and I can't deduct that anymore? And it's out of the blue, right? Well, I've always talked about how that was an issue for my clients. This year, they're increasing that cap to $40,000.
Woo!
Listen, that's the only round.
Let me write that down. Let me write it down.
It's the only round of applause I can get to this administration, honey. So outside of that and a few more things that this one big, beautiful bill did, that's major for people with higher incomes. So when I'm talking about higher incomes, I'm talking about people whose incomes are somewhere around $100,000 or more, right? And this is a household. This is either one person or a married joint couple. And you own a home and you're paying high property taxes on your home. But also, guess what? I paid $9,000, $10,000, $11,000 in state taxes.
Yes.
In my withholdings from my job. So now I can take that whole $20,000 that I paid in this year to my state as a deduction. So where I was seeing a deficit before and my liability was higher from 2018 up until now I'm going to get a little bit of relief in that place. And I'm not even going to say a little bit. It probably will be a significant relief in that place. I'm talking about maybe a couple $1,000s that you can expect to save, being able to include and deduct all of that. So that's a significant piece. And I want people to kind of, recognize that will be a benefit to them going forward. And then one of the things that we're seeing right now is a lot of people that are probably supposed to be retired aren't retired. Retirement is changing. It's changing. The age is changing. People are still working, and they're working because they're having to work. Why? Because Social Security is not enough. Their retirement is seeming to be not enough. The markets are adjusting, they're changing. Inflation. There's a whole host of reasons why people are having to work longer. So because of that, this bill is going to help address the people that are 65 and older, people approaching retirement, in retirement, and increasing the standard deduction significantly for them. Okay, so the standard deduction, for people that don't know, is an amount of money that the government allows you just to blanketly take off of your income. So if you don't itemize, meaning I don't own a home, right? I don't pay charitable contributions. I don't have really high medical expenses. I'm not itemizing. I don't have these things. But the government will say, okay, well, you don't itemize, we'll give you this standard deduction. That standard deduction is going to increase for everyone. It increases every year due to inflation. However, this year it's going to increase by $6,500 for people over 65. And that's pretty significant. That means if my income is $50,000, I'm only going to have to pay tax on for 44,000 roughly, right? 44,500, right? As it relates to that $6,500 increase in the standard deduction. So I'm going to be able to decrease how much I'm having to pay tax on by $6,500 if I'm over 65. And that's really significant because we want people over 65 and in retirement to feel, first of all, that they can retire. You don't have to work forever. Like, we're going to give them a plan so that one day they can actually feel like they can stop working, make room for younger people that are looking for jobs, right? So, and be able to sit home and relax. So that's going to increase. So there are some things that are going to be working in the favor of the older community this year that I hope people will see benefit there as well. So tax on tips, right? So there's a cap on the tax that you pay on tips. 25,000 is the maximum. You can actually remove that from your income if you're in a certain industry, like cosmetology, you're a barber, you're a hairstylist, you work in a restaurant, so you're making these tips in cash. They're going to remove this money as taxable income. That's going to save a lot of people in those industries quite a bit of money. Overtime is another thing that's actually going to see they aren't going to be taxed up to, I want to say it's 25,000 for your overtime work. If you've done overtime in your job and that's showing up in your W-2, that overtime, you're going to be able to take 25,000 up to 25,000 of that and not pay tax on it. Right. So that's going to be significant for those folks too.
Yeah, those are really important things that people need to know. You mentioned people who are retired or retiring. What about young people? And when I say young people, really young people, those who are in their 20s, who have just entered the job market, say those, for example, who graduated from college in 2025 or even 2024. And are getting those first career trajectory jobs, who are not making six figures. They're making 50,000, 60,000, being generous here, maybe 70,000. I'm talking, of course, about, those jobs that would be attained in the DMV, because like you said, it costs more to live here. And so some people are paying more. When do you believe a young person should, come to you or other enrolled agents to have their taxes done when their taxes are just not complicated?
You know what? I'm going to tell you what I do in my practice. My clients, when their children become of age, when they start to work and actually have an income that is taxable, I tell them, bring me your child. Bring me immediately. Okay, because I want to break generational myths. I want to talk to them about the expectation. I want you to come as soon as you get that first job, that first W-2 that's going to require you to pay tax on it. You worked at TJ Maxx all year, your income is over 13,000. I want to talk to you. And guess
Mm-hmm.
what? I'm not going to charge your child for their first tax return. Why?
Mm-hmm.
Because that's an educational session. That's 30 to 45 minutes that I get to talk to them, answer whatever questions they have, ask them questions and help them prepare for when more money starts rolling in. So I don't want you to even wait until you finish that master's and you got that $65,000 job. I want you to come in when you get that first job. Okay, because I
Mm-hmm.
need to change your mindset around the idea of having a refund. All right, because we've always had this thought that we should be getting refunds, but we need to understand the fundamentals of having a refund is that I've given my money to someone else to hold for me for an entire year when I could have been saving that money in my own interest bearing account, right? So we know that Uncle Sam is putting that money in an interest bearing account of their own when they're holding on to your money all year. So, no, I want you to break even. I don't want you to be thinking about refunds unless you have a credit that is due to you. Credits are money that the government is giving you to do these things they want to incentivize you to do. So they want you to go to college to give you education credit. And they want you to in any types of credit. They want you to buy a car, they give you a car credit. This is what these are government incentives. That's not your own money. That's them giving you money to do things they want you to do. You giving them your money to hold, that's a refund. And that's a non-starter. In the beginning, let's talk about that. When you first do your tax return, we're focusing on breaking even. You give them exactly what it is they're supposed to have, and you keep the rest and you invest. So let's talk about investments and what that looks like. Small investments for an 18-year-old, a 19-year-old, right? Let's talk about those people that have $65,000 jobs when they're coming straight out of school and they have a retirement plan that's available to them. Let's go ahead and put money in there. Why? Because you can actually, the money that you put into your retirement plan is tax deferred. They're not going to pay, they're not going to charge you tax on that money. So you're saving money in two ways. You're not paying tax on the money, but you're also putting money into a retirement plan that could easily be thousands and thousands of dollars 10 years from now. Right. So these are the types of things that I want young people to know, that you can use the tax code to your advantage early on. And you need to change your mindset a bit around, especially, and I'm just going to say it, in our community, we have a particular mindset around tax time.
Yeah. When March comes, you see a whole lot of Black folks looking like they're chewing on lemons.
Yes. Things just tight, right? So, and I'm just like, okay, we need to not be, one, afraid of tax time, but we also need to not be looking forward to it. Because all year long, we need to be planning and doing things creatively with our money on our own. Prime example, if I'm breaking even on my paycheck, that means I may be getting an extra $300-$400. Okay, because I'm not looking for this refund to come. I'm not looking for this $2,000-$3,000 refund. I'm getting an extra $200-$300 on my check per week. Because when I finish my tax return, I'm either going to give maybe a couple $100 on one end, or maybe I owe a couple hundred, but I'm breaking even. When I get that extra $200 or $300, what can I do with it? I can invest in stocks. I can put it into my retirement plan. I could use it towards other investment opportunities in my home. I could pay a bill with it. I could pay down my credit cards with it. I could do certain things. I could even just simply put it in a savings account that has a 3% interest rate on it.
Yeah.
Like I can do simple things to my advantage. I can use the taxes to my advantage, where I'm not looking forward to tax time, nor am I afraid of tax time. I've done my part. I've given the government what they asked me for, and now I can move on.
Hold that point, Stephanie. I have so many more questions as we talk about end of the year tax tips. So we're going to take a quick break, but don't forget you can hear this in every edition of the Daily Drum Insight segment via podcast on WHUR.com. The original Quiet Storm with Raheem Devon is coming up next on WHUR-FM. This conversation continues on Sirius XM, channel 141 in just a few seconds. Welcome back to the Daily Drum on Sirius XM, channel 141. I'm Harold Fisher. We continue our conversation about end of the year tax tips. My guest is Stephanie Fauntleroy, owner and director of Baker's Tax and Accounting Services. One of the other things, Stephanie, that I don't think a lot of people have been thinking about, as we know, in the DMV, and indeed across the country, federal government workers have lost their jobs. Some of those jobs were well-paying positions, and they lost their jobs in April, in May, in June, July. Some of them have not been able to find employment. What does that mean for those? What does that mean for tax time for those people next year?
So yeah, and before I go into what they need to do, I just want to extend, just my care and concern for people, because I have a lot of clients, and I didn't even realize until this past season how many clients I had that work for the government. And so it was a little bit of a sad time. So I just want to extend my care to these people, because it's just so out of the blue. What I will say is, for those people that did receive income at any point in 2025, you absolutely will have to file a tax return. Okay.
Right.
So if you work January, February, March, April, you'll receive a W-2, right? And for many of them, they may have received some sort of retirement distribution because they're no longer working. So they give them everything that was in their TSP, or maybe they gave them some sort of buyout, or something happened. So you may get another W-2. You may have a 1099-R because you were let go, so you had to take money out of your retirement plan in order to live, right? So for all of these months, you've been unable to find another job. You've had to go into your TSP or your any other retirement vehicle that you have and take that money out. That's still taxable income, unfortunately, right? So you should be looking for a 1099-R in the mail. You're going to get that. You're going to get your W-2 in the mail. So yes, you should still be prepared to file a tax return, even if you haven't gained employment as of yet. Speaking of that, if you filed for unemployment, the state will send you a 1099-G. It's a government state form. So you need to be on the lookout for that as well. That's going to be your unemployment compensation. That is also taxable income. Okay. So we have taxable income from your W-2, taxable income from a 1099-G, taxable income from a 1099-R for retirement. All of that is going to need to come to your preparer, right? In addition to whatever other deductions you have, right? So let's make sure, if you're paying a mortgage, you still have your 1099 for your mortgage interest. You still also have other income, right? So 1099 INTs, DIVs, Bs, those are investment 1099s, right? So if you have a savings account that's drawing interest in a bank, you might have a 1099 INT if it's over $10. If you have investments in a stock and you receive dividends, you might have a 1099 DIV. Say you were let go, or maybe you just needed some money. You had money in your stocks. You took money out, or those stocks had a gain. You will receive a 1099-B for that. That's all income. It's all taxable. All of that needs to be needs to be gathered up and presented to your tax preparer. Because unfortunately, the tax code doesn't really care about your story.
Right.
All they care about is the income. right? And so even if you're unemployed still, you still have to file your taxes by April 15th of next year, or you can do an extension, but the deadline is still the same.
Yeah. One of the things that I've also noticed and have been talking to a lot of people, uh, as you know, there's been a rise in sports gambling, and
Mm,
people have really been going, all in. I'm not a gambler, so I don't understand it,
mhm.
but I do know that I've spoken to people who have made some money this year. And every weekend, somebody has made $2,000 or $3,000,
Mhm.
$4,000 or $5,000.
Who are these people? They need a friend.
Yeah, they are. And family and friends.
Yeah.
I mean, they're not betting on the Commanders, but that's a different show. But
Oh, don't talk about my commanders too bad. Now, that's
right,
not too much on my
exactly, right.
commanders. Mm,
Or the Giants or the Cowboys for that matter. But with that said, I'm just counting in my head. If you made $1,000 this week, and then the week before you made $2,000, and the week before you made five, and the week before you made it made three. Well, that stuff adds up.
it does.
So I'm assuming, what is
Whew.
it? What, Bet MGM and FanDuel and all of do these places, are they going to send you a document?
Some places do, right? And some places actually just give them to you, right then and there. So if you go to like the MGM or any other casino and you win over a certain amount, I think it's $600, they will issue you. They'll ask you for your social security number and they will issue you a W-2 G
Mm.
for gambling, right? So I think one of the most important things to come out of this conversation is for people to know that it is income, right? When you win, the IRS says this, and remember this. This is the goalpost. You find $1 on the floor is income. Okay, you have to report it. You have a reporting requirement. So W-2 Gs, they come from MGM and different casinos like that, but they don't always issue that. So FanDuel, those other places, they don't always issue a W-2G, but they still have mechanisms and ways to let the government know that you won this money. They've given you this money, right? Because every entity is reporting, and they're reporting. They're reporting because what they receive from you as income, what they have to pay back out from you is a
Mhm.
deduction for them. They're still paying taxes to these corporations. So they have to report all of these things. And that's reciprocal. So if they're reporting to the government, they're going to also report to and for you. So you have to be on top of what it is you've won. You need to know what I won from FanDuel. So go back to FanDuel, check your records, see how much they say you won from them, right? So the interesting thing about gambling income is that you can write off up to what you won if you could substantiate that's what I spent. So, for example, I go to 7-Eleven every day and I buy lottery tickets and they cost me $2 a pop. I buy 10 of them a day. It's $20 a day I spend on these lottery tickets. I
Mhm.
get to write off the combination of that. So everything that I've done for that whole year at that 7-Eleven, all the money I've spent is deductible for me. So let's just say I won 10,000 from the lottery tickets, but I also spent 10,000 to get that 10,000.
Mm.
Then I don't have to pay tax on that money
Mhm.
to a degree. And I don't want to overcomplicate it, but I have to explain this all the time. Income is compoundable. I'm going to put that $10,000 in income that I won from the 7-Eleven scratch off ticket on top of my $100,000 W-2 income from my job.
Mm.
I am going to end up paying tax on $110,000.
Mhm. Because you won $110,000 from the lottery.
I won 10,000 from the lottery. I got my income from my job. I'm at $110,000. Now, on the flip side, I get to reduce that 110,000 because of my deductions. Some of my deductions are my charitable contributions, my medical expenses, my house interest, and my gambling payouts, money I paid out. That's a deduction. So I get to
Mhm.
reduce that 110, but that 110 is what is setting my tax rate.
Yes.
So I'm paying a higher tax rate because of that gambling income. I may not be
Mhm.
paying tax on that income specifically because I washed it out
But you entered into a higher
into
tax
another
bracket.
tax, into a higher tax bracket, right?
So what
People
happens?
have to understand that too.
So what if a lot of people are trying to win the Powerball, and and obviously no one has won.
Mhm,
Uh, the money that you spend during the course of the year
mhm,
trying to win the Mega Millions, Powerball, whatever,
mhm.
if you don't win anything, can you deduct what you've spent trying to win?
No. So
Okay,
you can only deduct up to what you've won,
I see.
up to
Okay.
what up to what you report as income. So if I
Hmm.
report 10,000, I can write off up to 10,000.
Hmm.
I don't report any income because I didn't win any income. I cannot write off my losses.
Let's talk a little bit about, we are obviously a week out, not a lot of time, but what should people do starting today in between, finishing up Christmas shopping and preparing to cook Christmas dinner? But what should they at least try to keep in mind, what they should write down, so that they, after Christmas Day, they need to get their hustle on to help lessen the impact of April 15th next year?
Couple of things. So if you are just doing your personal tax returns, you do not have a
Hmm.
business. You're doing your personal tax return, and you do itemize, for example, right? So you do, like I said before, you have a home, you write off your mortgage interest. You may have really, really high medical expenses because they got to be super high for them to land on your tax return, and you like to give to charity. So maybe, you got a couple extra thousand you could give to your church. Maybe you need to clean out that basement and you got a little bit of time because you're off. You off work this next couple of days, right? Maybe you can go do some purging and take some
Hmm.
stuff to Goodwill, Salvation Army, call Purple Heart, they'll come pick it up for you, but make sure you get your receipt because those charitable contributions can help to reduce your overall taxable income. You can do that all the way up until December 31st. I have a client that literally calls me and says, we know I made this much money this year. I know, I've been paying estimated taxes. I may fall short ever so slightly. I don't really want to owe more. How much more can I give to my church? Because she's an avid tither.
Hmm.
And she's like, how much more? And I'm like, okay, let's look at the numbers. And I crunched the numbers, call her back in 15 minutes ago, go on and give the church $7,000.
Hmm.
Like if you have the wherewithal to do that, right? As a personal earner, W-2 earner, working, but you itemize, yeah, go ahead and give a little bit more to charity if you can, right? Go ahead and put a little bit more into your retirement account,
Yeah.
right? Up to what the maximum is, because I know that that's a benefit for me in my retirement account, and it's going to reduce my taxable income overall. One, it's a no-brainer if I have the wherewithal to do that. A lot of people are working on shoestring budgets, so they don't have a whole lot of room, to do a lot at the end of the year at this point. But again, small things like I said, like you can, gather up some items and get $300-400 worth of deductions. Maybe you got a clunker of a car, call Cars for Kids, and that's a $500 deduction off the break. If they sell it at arm's length for $1,000, you can write off that $1,000
Hmm.
as
Hmm.
a deduction. Whatever they sell it for is what you can write it off for, right? But if they don't sell it for anything, you just give it to them, you still get a $500 deduction, right?
Mm.
So, like, we want to look at those things. We want to look at maybe if I have a little bit of extra money, I can put on my student loans We know that student loan interest is deductible, right? So the more I pay on my student loan interest, the more I can write off on my 2025 tax return if I have a little bit more money to do that. I want to look at my W-4, make sure that my filing is right, my filing status is right. If I got married, I need to change it to married joint. I want to look at the W-4 and make sure I'm withholding what I'm supposed to withhold, especially going into the new year. So I've made changes to my W-4 because I'm not working, as much. So I need to bring home more money. My hours were cut on my job. I need to bring home more money. So I've changed my W-4 in order to do that. Well, if I keep it that way too much longer, then I'm going to end up owing because I didn't pay in enough. So I need to reevaluate my W-4 sometimes. I need to come back to it and look at it and make sure I'm good. But yeah, those are a couple of things.
You mentioned life changes. What about someone who got married this year? Maybe somebody who got divorced this year, or someone who had, a baby this year. How do those things come into play?
That's always an exciting part. Like when people do bring the baby in, now we're talking about child deductions. Now we're talking about head of household, we're talking about it decreases in liability across the board when you're bringing in the babies. So that's always, but people kind of know that, right? So when they come to me, they're always like, I had a new baby. I'm like, yay, let's get the baby on the return so we can, reduce his income here. But make sure you have your social security number for the baby. Because especially if it's a new baby, maybe born around December, November, sometimes they don't always have that social security number handy, but you have to have that in order to put the baby on the return. So make sure you have your social security number, full name of the baby, make sure you're giving the proper documents so the baby's name isn't spelled incorrectly. But yeah, once you've done that, you can go into your W-4 and change your filing status from single to head of household. If this is your first baby. If you got married, make sure you change your W-4 to married filing joint. But I also say have a discussion with your tax preparer, right? Because sometimes married joint is not optimal. There are instances where I need to stay separate from this person financially, or at least in the tax world, right? So let me call up Stephanie and say, all right, well, we got married, but my husband owes child support. They're gonna come into his check. They're gonna take my refund because of child support. So maybe we should file separate. They come in and the wife has a boatload of student loans, and maybe they haven't been paid on, and the government is gonna come in and snatch those student loans right out of that refund. And he's like, I don't want to have anything to do with her past debt. Married filing separate could be an optimal way of filing, right? So you want to have those conversations and then change your W-4, because your W-4 should reflect your living status, right? So head of household, single, married filing joint, or married filing separate. One of the things that people don't really know is that if you get married before December 31st of whatever year you're in, you have to be married joint or married separate when you file your return. You cannot any longer file a single return, nor can you file head of household. You cannot file head of household if you are married. I want people to let that sink in. Because literally every time they're still trying to, because it really is an optimal filing status. It reduces your taxable income. It reduces your tax rate. It's the better filing status. However, it's not for you anymore. You have to choose married joint or married separate. One of the two. The other two don't apply.
In the words of The Color Purple, we's married now.
We's married now. You might as well go on, So have those conversations with the folks that that you trust.
What about people who work from home? Is there a difference between whether or not you have a home-based business or just work from home? Are the deductions the same or different?
That's a really great question, Harold, because yes, it's different. It's different. It wasn't different for some time to a degree, but when the 2018 tax laws came in, it just washed the slate clean. It was a very weird time. And when that happened, people were no longer able to write off their home deduction for working from home. Right. So if you're working from home, which many of us do still, you used to be able to write off a portion of your electricity, a portion of your cable bill. If you had to buy a computer for work, you could write that off. If you were a nurse and you had to have certifications, you could write those things off. Any type of deductions that you had as a working person, you could write those things off as unreimbursed employee expenses. That got taken away in 2018, and it has not come back yet. Okay. So that's not part of the One Big Beautiful Bill. It's not something that has been brought back to us. So no, it is different. However, take myself, for example. If my office is in my home, I am self-employed, I can write off everything as it relates to my home office expenses. Okay. So I can write off a fraction of my mortgage interest, a fraction of my property taxes, a fraction of my utility bills, a fraction of my cable, as it relates to the space that I use in my home, right? So you figure out what that fraction is. If I use 200 square feet out of a 2,000 square foot home, we're talking about 200 over 2,000, right? So that's basically about 10% that you get to write off from all of these expenses from working inside your home. Right now, if I'm working in my home and I'm a home-based business and it's not house related, like I bought furniture for my office, I bought a desk, I bought my computer, I do all of the other expenses that I have in order to operate this business are 100% deductible. Right. But the home office, as it relates to you working for someone else, is not a deductible space.
One of the things that I was pleasantly surprised about that I was able to do, so I had insulation updated in my house, and the company said there is a federal tax credit for that. Also and not just for things like insulation, but if you updated major appliances, HVAC, and the like, there are federal tax credits. Does that end this year? And I'm not the one to explain it. That's why you. So how does that work for those who get insulation, new HVAC that are energy efficient, and and this is the last year for that, I would imagine.
Yeah, so they have not extended the so that's another thing that has not been extended, that ended in the 25. So the energy efficient home credit, right? So again, to kind of go back to what I was talking about before, how the government incentivizes you. So people don't really understand that the tax code is an incentive-based product, basically. So it's basically saying whatever this government wants you to invest in, they're going to incentivize you to do it inside of the tax code. So when you think about home energy efficiency, we're thinking about climate control. We're thinking about, if you think deeper into it, we're thinking about we want people to, move to electric, vehicles and energy efficient products and appliances. That was the Biden administration, right? That was the Obama administration. That those were the things that they cared about. So guess what? That time has passed. Those things are done, so we're not focusing as much on climate control and things like that. So those energy efficient credits and upgrades to your HVAC and your furnace and your insulation and all those other things. Yeah, we kind of missed the window on that. But I want to also take a look at, people may have heard about the vehicle deduction, the new vehicle deduction. So there's a new vehicle deduction that is out there. Why? because the government wants you to buy new vehicles, right? So what are we going to do to make people want to buy these vehicles? Okay, so if you purchase a new vehicle that was made in 2025 or going forward, you can actually write off up to $10,000 in the interest that you pay on that vehicle. And that's pretty significant. That's an itemized deduction that's going to come on your Schedule A if you purchase a new vehicle. So there are requirements and stipulations there, criteria that you have to meet, right? Or be under, right? So you have to have income under a certain amount. Your car has to be brand new, built and made in 2025, so those are, they're kind of strict stipulations, but if you can take advantage of that, it would be significant. Why? Because vehicles are very expensive right now.
Yes.
They're really, really high. And so part of if you go to your bank and get a 9% loan, 9% interest rate on this loan for this car, $90,000, you know what I'm saying? That could be a pretty significant deduction. You could maybe take that whole $10,000 deduction. So again, in real numbers, my income is $10,000. I get to deduce, my income is $100,000. I get to reduce that to 90 because I'm taking the $10,000 that I paid in interest on this new car off. Right. So that's what real numbers look like. But again, you have criteria, I hear a lot of it floating around and people are like, well, you can take off 10,000 in your car. And I get questions all the time via text and email. Well, can I do? And just to clarify, it has to be a new car. Your income has to be under $150,000. Right. So there's stipulations there, but it's still, if you're in the market for a new car, it's still a pretty decent deduction.
Yeah. So you have a week to Merry Christmas.
Merry Christmas.
Merry Christmas.
But listen, for all those parents all out there that may, have a little bit of money extra to spare and they were planning on putting a bow on top of a new car for their kid or something like that, that's something to consider. They can, if they put their car in their name.
There you go. Can I deduct the bow?
Listen, just don't tell me you did it. You know what I'm saying? But that bow is gonna have to stay on you. But the 10,000 for that interest, again, really high. You can absolutely do that. So you don't have much time. So I know people are out here probably rushing. They're rushing to the car dealers and then jumping back in their old car and rushing back home once they see these prices.
Yes.
But at the end of the day, if you can afford it, there's a credit out there for you, or deduction rather, not a credit. But
Stephanie Fauntleroy,
yes, sir.
Owner of Baker's Tax and Accounting Service. Thank you so very much. It is always a pleasure talking to you, and you're so informative and just letting people know that there is help out there and things that they can do. So I really appreciate it.
Yeah, thank you, Harold. I appreciate you. And if you folks want to reach out to me and have more questions, they can visit me at bakerstaxservice.com.
And we're going to post that on our website along with this interview tonight after 7:00. So for those who can't remember that, it'll be on our website on WHUR.com.
Yeah, absolutely. Thank you, Harold. I appreciate you.
Thank you. And happy holidays to you, by the way.
Well, thank you, sir. I look forward to not spending any money on anybody.
There you go. How about that?
Good talking to you, Harold. Have a happy holiday. If you have any tax questions, you know who to call.
Absolutely. That is the Daily Drum for this Tuesday, December 23rd. I'm Harold Fisher. Good night.